Buckle up, folks, because today on Boss Economics World, we're diving headfirst into the Middle East and North Africa, MENA, region's economic dumpster fire, courtesy of the International Monetary Fund's latest growth downgrade. Oh, and surprise, surprise, it's another episode where government mismanagement, global trade wars, and OPEC plus blunders have turned oil-rich nations into economic cautionary tales. If you're an everyday Joe worried about your financial future or a finance pro trying to make sense of this mess, stick around. We're about to unpack this economic circus, layer by layer, from the surface clownery to the deep-rooted policy disasters. And trust me, the data we've got today is hotter than a Saudi summer. Let's start with the headline that's got everyone clutching their pearls. The IMF just downgraded its 2025 growth forecasts for oil-exporting countries in the MENA region to a measly 2.3%. That's a whopping 1.7 percentage points lower than their October 2024 prediction. Translation: the economic wizards in Washington are basically saying, oops, sorry, oil-rich nations, turns out your economies are tanking harder than we thought. And who's getting the worst of it? Iraq and Saudi Arabia, the poster children of oil dependency, are seeing their GDP forecasts slashed like a Black Friday sale gone wrong. Iraq, oh boy, Iraq, the IMF now expects its GDP to contract by 1.5% in 2025, instead of growing by a rosy 4.1% as they predicted just 6 months ago. Meanwhile, Saudi Arabia's outlook got downgraded from 4.6% to a still positive but much less impressive 3%. And the MENA region as a whole? A pitiful 2.6% growth, down 1.4 points from the IMF's earlier estimate. Yawn. Is anyone else tired of watching governments fumble the ball while their economies slide into the gutter? Now, let's peel back the first layer of this economic onion and talk about the obvious villain, oil prices. The IMF expects oil to average $66.90 per barrel in 2025, nearly $6 below their October 2024 projection. And if you're paying attention to the markets, Brent crude has already slumped 15% this year to around $63 a barrel. Why the nosedive? Well, folks, it's a perfect storm of stupidity, escalating global trade tensions, looking at you, US-led trade wars, and OPEC plus deciding, hey, let's flood the market with more oil than it can handle. Because apparently, nothing screams economic stability like oversupplying a product when demand is already weaker than a decaf latte. But here's the kicker, this isn't just about oil prices dropping. It's about governments and policymakers who've spent decades riding the oil gravy train without a backup plan. When oil prices tank, these economies don't just stumble, they faceplant. And who suffers? Not the suits in Riyadh or Baghdad making these boneheaded decisions, but the everyday workers, small businesses, and families trying to survive in an economy that's rigged against them. Let's dig a little deeper, shall we? The IMF report points a finger at escalating global trade tensions, and we all know who's leading that charge, the United States, with its tariff-happy policies that are shaking up global markets like a toddler with a snow globe. The US-China trade war, now in its umpteenth season, has slowed global economic growth to a crawl, with the IMF projecting global GDP growth to hover at just 3.2% in 2025, barely enough to keep the lights on, let alone fuel demand for oil. And here's the latest data to back this up. According to the World Trade Organization, global trade volumes are expected to grow by just 2.7% in 2025, down from 3.4% pre-trade war levels. Why does this matter for MENA oil exporters? Because when global trade slows, demand for oil, the lifeblood of these economies, dries up faster than a desert oasis. China, the world's second-largest oil consumer, has seen its industrial output growth slow to 5.6% in 2024, down from 6.8% in 2022, thanks to US tariffs. Less industrial activity, less oil demand, lower oil prices, you do the math. But wait, there's more. The IMF notes that the direct impact of tariffs on Gulf Cooperation Council, GCC, countries is generally limited because of tariff exemptions on energy exports and limited non-oil exports to the US. Oh, great, so they're not getting hit by tariffs directly, they're just getting crushed by the collateral damage of a global economy that's choking on trade war fallout. Bravo, policymakers, for standing by and watching the chaos unfold. Now, let's zoom in on OPEC+, the so-called guardians of oil prices. These guys decided that 2025 was the perfect time to ramp up oil production, even as demand was already softening. Genius move, right? According to the U.S. Energy Information Administration, EIA, non-OPEC+ countries like the U.S., Brazil, and Canada are pumping out oil at record levels, with global supply expected to grow by 1.8 million barrels per day in 2025. Meanwhile, OPEC+ announced in late 2024 that it would increase output by 1 million barrels per day starting in January 2025, a decision that analysts at Goldman Sachs say will keep oil prices below $70 per barrel through mid-2026. Here's the thing, folks, OPEC+ isn't just reacting to market conditions, it's actively sabotaging its own members. Saudi Arabia and Iraq, two of the biggest players in the cartel, are now stuck with lower oil revenues, forcing them to recalibrate, their investment spending plans. The IMF report explicitly says this recalibration is a direct result of softer oil prices, amplified by trade tensions. In layman's terms, governments are cutting back on infrastructure projects, social programs, and diversification efforts because they can't afford them anymore. And who's to blame? OPEC+ for flooding the market, and governments for not having a plan B. Now, let's get to the rotten core of this economic apple: government mismanagement and chronic oil dependency. For decades, countries like Saudi Arabia and Iraq have treated oil as their golden goose, assuming the good times would never end. Saudi Arabia, for instance, relies on oil for 60% of its fiscal revenue, according to the IMF, while Iraq depends on it for a staggering 92%. When oil prices drop, these economies don't just take a hit, they implode. Take Saudi Arabia's Vision 2030, the crown jewel of its diversification efforts. Sure, they're building futuristic cities like NEOM and investing in tourism, but the reality is, non-oil growth is still dwarfed by oil revenues. The IMF says non-oil growth in the Gulf will be bolstered by infrastructure projects, but here's the catch: those projects are funded by oil money. When oil prices tank, the funding dries up, and the diversification dream stalls. Just look at the latest numbers. Saudi Arabia's non-oil GDP growth was 4.4% in 2024, but with oil revenues projected to fall by 15% in 2025, analysts at Oxford Economics predict non-oil growth will slow to 3.8%, hardly the economic transformation they promised. And Iraq? Oh, Iraq is a masterclass in economic mismanagement. Years of political instability, corruption, and underinvestment in non-oil sectors have left the country utterly dependent on crude. According to the World Bank, Iraq's non-oil GDP accounts for just 8% of its total economy, a pathetic figure for a country with so much potential. Now, with oil prices in the gutter, the IMF expects Iraq's economy to shrink by 1.5% in 2025. And what's the government's response? More borrowing, more austerity, and more suffering for the average Iraqi citizen. Here's the Boss Economics World takeaway, folks: this economic mess isn't just about oil prices or trade wars, it's about governments that have failed their people time and time again. Instead of diversifying their economies, they've doubled down on oil. Instead of building resilient systems, they've built houses of cards. And instead of standing up to global economic bullies, they've sat back and watched their economies crumble. So, what's the solution? First, MENA governments need to get serious about diversification, not just in words, but in action. That means investing in education, technology, and renewable energy, even when oil prices are low. Second, OPEC+ needs to stop playing fast and loose with production quotas and start prioritizing stability over short-term gains. And third, the global community, yes, that includes you, Uncle Sam, needs to stop treating trade wars like a geopolitical game of chicken. Because at the end of the day, it's not the policymakers who suffer, it's the everyday people trying to make ends meet. Here at Boss Economics World, we're not just here to rant, we're here to wake you up. Whether you're a regular Joe worried about your financial future or a finance pro trying to navigate this chaos, remember this: the economic clown show isn't inevitable. It's the result of bad decisions, bad policies, and bad leadership. So, demand better. Call out the clowns. And stay tuned to Boss Economics World, where we'll keep shining a light on the economic messes that matter. Until next time, folks, keep your wallets tight and your eyes wide open.